All right. Well, I don't think it's fair to necessarily wait any longer. I will go ahead and start our webinar. Just as a bookkeeping item, please go ahead and put any questions you may have in the chat. At the very end of the presentation, we will go through all of the questions. If we're not able to get through everything, we'll make sure to reach out to you with an answer after the webinar. So first of all, I want to thank everyone for joining us who's live. And if anyone is watching via the recording, thank you for joining us. As many of you may know, there's a lot of ways to build wealth, and one that we see very common, especially in the medical community, is through real estate. Now, real estate, for all of its good things, such as the ability to leverage, such as the ability to physically hold on to an asset and monitor it yourself, also comes with a lot of downsides. And one of the biggest downsides that a lot of our clients come to us with is this idea that they can never seem to recognize the benefit of holding that real estate unless they pass away and give it to their children, because there's just so much depreciation recapture. There's a lot of long-term capital gains, perhaps. And so they're oftentimes forced to do what is known as a 1031 exchange. So at My Financial Coach, what we do is we pair our clients with our subject matter experts to solve some of these issues once we've identified them. A little bit of background on My Financial Coach. All of our clients get their own certified financial planner who is a salaried individual who has a bonus tied strictly to their ability to help retain their clients. And that gives them the idea that anything that they want to pursue, whether it's building wealth via real estate or building wealth via investments, such as ETFs, mutual funds, etc., they will get the advice that they need to be very efficient at building up their wealth. So looking into 1031 exchanges and real estate, I'm very glad to have Michael and Max on the line with me, and I will pass it to them to make an introduction of themselves.
I am Mike Scherer. I am with RCX Capital Group. We specialize in tax-advantaged real estate solutions. We're thrilled to participate in this webinar to share our knowledge and experience, and hopeful that everyone listening will walk away knowing the ins and outs of completing a 1031 exchange.
Max Moritz with Wellington Wealth Strategies, as Impo kind of hinted, is subject matter expert on the real estate side of the world. Whether it's from the REITs to individual holdings, to Delaware statutory trusts, working hand in hand with Michael and RCX and a team of professionals to provide kind of the best solutions for our clients.
Fantastic. Well, I would love to kick off and go ahead and share my screen, Impo, and start a discussion around 1031 exchange. So before we start the actual webinar itself, I'd love just to kind of read a quick disclosure, which is required. Just want to let everyone know that the opinions expressed by RCX Capital Group and our partners on this webinar are their own and do not reflect the opinions of any other third party. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific security, investment, or investment strategy. Investments involve risks, and unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendation appropriate for any individual. Listeners are always encouraged to seek advice from qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Lastly, past performance is not indicative of future performance. So with that, I would love to dig in and talk about what I think is an amazing tax tools. So one of the things we love about My Financial Coach is they bring all these useful tools together with amazing financial advisors like Max. They bring these tools and they deliver these tools to investors within their network. 1031 exchange should be considered one of those tools. And if you own investment real estate, it is a fantastic tool and a very useful tool for building wealth. So in today's webinar, I'd like to go through some of the highlights of what a 1031 exchange is and why we facilitate 1031 exchanges. I want to educate everyone on the 3 primary rules around completing a 1031 exchange. And I want to highlight some of the common pitfalls because I really don't want anyone on this webinar making the same mistakes we see happen day in and day out because people don't understand how to facilitate a 1031 exchange. And lastly, I just want to make sure everyone knows how they can mitigate those common pitfalls, which really the cornerstone is proactive planning through your My Financial Coach team. So everyone hears the number 1031, and it refers to Section 1031 of the IRS Code. And it basically says that any real estate held for investment purposes, you can sell that real estate and defer the gain if you invest in like-kind real estate. I want to make sure that if you understand one thing, understand that Section 1031 does not refer to your primary residence. That is Section 121. Although you can utilize a 1031 in conjunction with a 121 if you're selling your primary residence and there is a business that is attached to that residence. So within Section 1031, there are different types of 1031 exchanges that an exchanger can embark upon. The most common 1031 exchange is a forward exchange, and that is really what I'm going to refer to today. There are reverse exchanges as well as improvement exchanges. The difference between them is a forward exchange means you're selling your relinquished property, and then you're identifying replacement property post-sale. In many cases, you can identify replacement property in a reverse exchange and then close on your relinquished property. And then an improvement exchange involves setting aside the proceeds and improving a property within a 180-day period. Very complex, but just making sure that you understand there are differences. And today's topic is really going to focus on the most common, which is referred to as a forward. I want to make sure that everyone understands the timelines. There are timelines that are outlined in Section 1031. I'll cover those a little bit later. I want to make sure everyone knows what the role is of the qualified intermediary. I want to make sure you know what your replacement property options are, what is defined as like kind, and I want to make sure that you're planning well in advance of the sale of your relinquished property. So who can take advantage of a 1031 exchange? Almost any tax-paying individual or legal entity can take advantage of a 1031 exchange, whether that's an LLC or you own it individually. The key here is it must follow the taxpayer ID. So we have the ability to accommodate exchanges originating in LLCs. We have the ability to introduce exchangers who might need to facilitate what's called a drop-in swap, dropping their ownership interest out of an LLC into via quitclaim deed to do a 1031 exchange in their own name. We have the ability and the resources to accommodate all those needs, but the key point here is it must follow the taxpayer ID. Common situations that lead to a 1031 exchange, we see businesses relocating. We see the sale of a business where they have a real estate component as well as a business component. We've done a number of these with the Wellington group. Also, we see investors looking to change investments due to market forces. So maybe they own a property in an area that is highly appreciated, and they think that that regional market has peaked, and they want to sell their investment there and 1031 exchange into another area. That is an absolute driver and something that I think investors across the country should absolutely be considering. All markets are different, and what is happening in one regional market could be a completely different dynamic in another regional market. And lastly, we see a lot of investors that think that they have the capability to actively manage real estate. And when they actually look at the returns that they're generating by actively owning real estate, they say, hey, I want to be a passive investor, right? So we see people saying, hey, I'm actively owning, I'm done. I just can't do this anymore. I want to sell real estate and get into a passive solution, something like a Delaware statutory trust. We also see people on the converse, where they're in a passive investment and they say, you know what, I'd like to try my hand. I think I have a lot of resources where I can be successful as an active investor in real estate. So we always see people toggling between active and passive as they facilitate their 1031 journey.
Mike, whenever we talk about active real estate or being active in the business, the number one question I always ask is, do you want to deal with the tenants or the renters? If the answer is no, then we should absolutely look at more passive type of real estate options.
That's absolutely correct. Or, to your point, Max, do you want to deal with toilets and rehab and all the headaches that come with active management? So that's something for the individual investor, and that's a great point. The other primary point is the math just makes sense when you're facilitating a 1031 exchange. So for the purposes of this call, we often run through this analysis with exchangers, and this really tells the story of, why do I want to facilitate a 1031 exchange? So these numbers are important, and every exchanger should know their specific exchange math. But let's just walk through an example. If you purchased property for $400,000, you've depreciated that property, you now have $150,000 as your adjusted cost basis. You've owned that property for a while. You've been the beneficiary of a pretty robust real estate market wherever that property is located, and you're able to sell that property for $1 million. You now have a total taxable gain of $850,000, where Section 1031 will allow you to put those proceeds from the sale into a qualified intermediary and work to mitigate this taxable gain. So if we look at the math, the total taxes due on that $850,000, again, this might vary from state to state, could be upwards of $327,000, which means that post-tax, you only have $672,000 roughly to deploy in your next investment. That is a huge difference versus scenario B, where you actually facilitate a 1031 exchange and you have the ability to invest the full $1 million in proceeds in your next replacement property. I would also like to highlight that there's some key terms that you should know in this journey, right? The first one is what a capital gain is. And that's the actual difference between the amount realized in the sale and your adjusted basis. So in this case, that's 1 million less your adjusted cost basis of 150. Equity, on the other hand, is the difference between the market value that you sold for and reducing it by all the financing debts that are encumbering the property, right? So what your tax is going to be based on is the actual gain, not on the equity. So I think it's a really important distinction. In exchanges, we often see some confusion, so I thought I would just take a minute and highlight that difference. So I used a key term, and that is replacement property. So again, when you're selling or you're listing your investment, whatever you're selling is typically termed as your relinquished property. Replacement property is what you can invest in on the next leg of your journey. And the relinquished property that you're selling must go into like-kind property. So we need to make sure that whatever you're selling is used in a trade or business, or it has some investment use. Things are going to be excluded, as I noted earlier, your personal residence, property primarily held for sale. They call this dealer. And the test there is, can the dealer segregate that from his investment inventory, right? So typically we see this as home builders, right? That is not eligible because those homes are held in inventory for sale. So making sure you invest in like kind, that's the first prerequisite, right? The second is making sure that once you sell your relinquished property, you have 45 days to identify your replacement property. And again, this is the typical forward exchange. So this is the key thing to note. Your property closes. You have 45 days to identify replacement property, which I would note goes very, very quickly. So again, proactive planning, understanding what you want to do, working with your team at My Financial Coach is imperative. Lastly, you must use a qualified intermediary in your 1031 exchange. I will expand upon what the qualified intermediary does a little bit later, but it is a necessary component to every 1031 exchange, and your exchange needs to be set up by that professional. So when we talk about like kind, I want to elaborate a little bit more because there's a lot of confusion in the industry about what exactly is like kind. Like kind is very, very flexible, right? Typically, as long as it's real property and it's held for investment purposes and is real estate in nature, it's likely going to qualify as like kind. Things that are included are commercial real estate properties, so things like car washes, gas stations. These are investments where you can leverage other tax mitigating strategies like cost segregation to enhance the tax advantage return profile of the investment. There are things like securities, typically Delaware statutory trusts, which can invest in a multitude of property types, qualify as 1031 eligible investments. And these are fractional ownership interests in institutional quality properties, oil and gas interests, mineral water or air rights, single family rental, short-term rentals, multifamily properties, land or farm qualify as like kind. Vacation homes, although there are tests around vacation homes, depending on your use of the property, it may qualify as like kind. And then also TIC interests. TICs are a little bit different. They're a little bit like a Delaware statutory trust. It stands for tenant in common. But there are some pitfalls that people should know about TICs as relates to all parties in a TIC agreeing to sell the property, things like that. But it is an eligible investment, and it could own a variety of property types. So expanding on the 45-day life cycle in a 1031 exchange, and this again is that third really key criteria that I want to make sure everyone understands fully. When we look again at any 1031 exchange, that key date is the close of your relinquished property, right? That is the timeline for both the 45 days and a new number, 180 days. So again, within a 1031 exchange, when you sell your investment property, you have to identify a replacement property in 45 days. You also have to close on what you've identified within 180 days of the sale of your relinquished property. Together, our team helps investors work within the property ID and sourcing the replacement property options. Depending on investor strategies, we could be using one of these three rules. Although the most common rules used in identifying and listing those properties you want to identify are going to either be the 3 property rule, where the exchanger can identify up to 3 potential replacement properties without any regard to value, but you must close on at least 75% of the value that you identify. And then we have the 200% rule, where you can identify an unlimited number of properties, but the total value of these properties cannot exceed 200% of the value of the relinquished property. So most of the time, again, depending on feedback from the specific investor, we would be working with you to help you figure these numbers out and identify what is a suitable replacement property portfolio.
Michael, say you start the process and you start the 1031 process and you identify a property, but it's not for the same, it's a lower total value than the property that you're selling. What happens in that sense?
Yeah, no, that's a great question. So I'm gonna key in on a few points. So let's just say you sold a property for $5 million and you found a key property that you love for $4 million, right? There's nothing that says you can't close on that property, right? You would just pay tax on the million that you didn't 1031 exchange into. Again, working with our team, our goal is to help you identify solutions that may help you with that million, other tax strategies within the 1031 exchange trade itself, to help you replace substantially all of your proceeds from the sale of that property. But again, what you don't replace in the 1031 exchange is just going to be taxable.
Got it. So basis goes first, gain goes second. Would that be fair to say?
Yes. The second thing that I would highlight too, Max, and I wasn't really clear on the question, but what I would say is this: you can also identify properties within the 45 days, right, with the qualified intermediary. Let's just say you identify something, and then all of a sudden, the property that you identified, you got a call from your broker and said that was sold. You could find another property, pull that property off your ID, and identify another property within the 45 days. So I would consider that ID process somewhat dynamic. So again, making sure you get an early start. If you feel like something you've ID'd isn't going to be available, you always have the opportunity before the end of the 45th day to identify something else. But what that qualified intermediary is going to do in this process is really play a key part. First of all, they're going to set up all your 1031 exchange paperwork. This is relatively streamlined. There's qualified intermediaries across the country. Some of them are more digital in nature, where you can facilitate the paperwork entirely online. Some of them are a little more, direct, where you're faxing. But they set up the paperwork. They're going to take all the information required to make sure that your transaction is set up properly and everything is reported properly to the IRS, right? This is very, very important. If you take receipt of the proceeds of your 1031 exchange, even though it might not be direct, you would be in constructive receipt of those proceeds and you would disallow the 1031 exchange. So if you walk away with anything from today's call, if you're looking at facilitating a 1031 exchange, understand the importance of the qualified intermediary, find a qualified intermediary that fits the criteria that I'm about to explain, and make sure you get that paperwork set up as early as possible. While you have a great deal of choice in the world of qualified intermediaries, we do think it's important to work with a qualified intermediary that has experience, because that qualified intermediary is always going to be a resource to answering questions. We have a robust list of qualified intermediaries that we work with. They're always willing to hop on a call and answer complex questions that perhaps our team might not have the answer to. And they can always advise on more complex 1031 exchanges, where really mapping out the exchange we need to really leverage their expertise. So very, very important. I can't tell you how many exchanges I have seen where the investor didn't understand the importance of a qualified intermediary, and I get a call a week after the property sold, and it's just heartbreaking because it's a mistake that can cost literally hundreds of thousands of dollars. So I'm about to summarize all the common 1031 mistakes, and they really tie into the key principles above, but I want this to be very concise. So if you have a place to go, you can see this. And then the second half of this webinar, I'm going to talk about how we mitigate these through my financial coach. So first of all, forgetting to set up your exchange before closing. Again, you have to use that qualified intermediary. Looking for full tax deferral in the 1031 exchange. Very common rule is when you sell your relinquished property to get full tax deferral, and Max was really wise to ask this question, to get full tax deferral, you need to invest all the proceeds from the sale of your relinquished property. Does that mean you have to? No, absolutely not. You can do a portion, but just know that you're going to owe tax on the portion that you didn't. And I would talk to your tax advisor well in advance just to know exactly what that tax liability is. Not identifying on time. Again, 45 days goes very, very quickly. So we always recommend proactive planning. Reach out to your My Financial Coach team if you're contemplating the sale, and get your specialists on the phone to help mitigate this risk. Again, waiting too long. 45 days goes very, very quickly. Waiting to close on properties that you've identified. You also run the risk of everything that you've identified selling out from underneath you. We have strategies that can help you identify what we call insurance IDs. So if you're going after a property, there's a lot of strategy in what you identify to help mitigate this risk. And then lastly, just making sure your exchange funds are safe. The qualified intermediary space is unregulated, so you always want to make sure you're working with a reputable partner and understand how they're holding your deposit funds. So when we look at a 1031 exchange, we're always looking at this, what we call a seller decision tree, right? And this is the aspect of every exchange. And it all starts with selling investment property. And while I understand there's a lot of sub decisions underneath this, this is the basic opportunity path. You could either do nothing if you're selling investment property and decide just to pay the gain on, just to pay the tax on the gain from the sale of that investment property. Unless you tell me that, hey, you have a desperate need for liquidity, I don't think this is a very viable option, and I would consider talking to your tax advisor or your My Financial Coach team to look at alternatives. The second one is a 1031 exchange, where you can defer all the taxes with the ultimate goal, again, in planning for generational wealth. You're going to 1031 exchange throughout your life, where ultimately your heirs are going to get a step up in basis. That's why groups like Wellington Wealth are here to help you plan for that long-term growth in those assets. And then in the 1031 exchange, you have this decision. Do I want to invest in a security that is passive in nature, where I'm hands-off, where I'm, taking in monthly income? I'm letting an institutional manager run that property, maximize efficiencies? Or do I want to go and invest in a direct investment, something like a single family rental or a short-term rental or a triple net lease property, something like a car wash, gas station? That's what we call that area. And the real distinction between is, in one, you're going to be an active manager. Now, again, I think you can maybe hire out certain aspects of that to get some passive attributes. But there's a lot of work there and there's a lot of cost. So I think when you embark on any 1031 exchange, it's really important to objectively weigh the pros and cons of each. So let's talk about what these portfolios might look like. And let's talk about the actual math behind these. And I want to walk through this so that you can see kind of how you can build a diversified portfolio down, again, any path. So, first of all, your options are great. You can invest from one state to another. But the real difference between going direct, again, is going to be that active ownership and the ability to control disposition, right? So this is probably one of the strongest attributes and rationales for going direct is if you want to sell it in 2.5, 3 years, you can make that decision and list it with your local broker. You have the ability to bring in your own alternative strategies, things like cost segregation, right? You can find a cost segregation provider and see if that might help you offset other areas, other tax liabilities. Both direct and securities are going to have very strong after-tax equivalent yields. And again, same benefit. You can use and invest in direct property and still get estate planning benefits. What are the drawbacks of this strategy? I think the biggest drawback with going direct is most properties are going to have a higher entry point, right? So in order to access a commercial real estate property, something like a car wash, you might need an exchange north of $2-3 million to get a decent property, right? There is no certainty of close. It is extremely challenging in today's environment to find replacement property. I can't stress this enough. To find not only the replacement property, but make sure that you have pretty strong confidence that during inspections, there's not going to be any headaches. And even more notably, which is the third point, what if you have to replace your financing? Again, I noted, when you sell your relinquished property, right, you need to replace all the proceeds. That includes the debt in the exchange. So if you have something financed at a very favorable rate, you might not want to sell it if you have to find new financing, because that environment, especially today, might not be cost advantageous, right? So these are all considerations that we can help you explore, understand as you navigate your opportunities. But again, in this situation, unless you have a lot of capital to deploy, right, you might only be able to find one investment, maybe at best two investments, right? So in this model, I'm showing sale proceeds going into two pretty common investments. I've modeled here a gas station and a car wash. Now I want to migrate into that second option, which is a very common vehicle known as the Delaware Statutory Trust. All right. A Delaware Statutory Trust is a structure that was approved by the IRS in the early 2000s and is considered a like-kind alternative. What is unique about a Delaware Statutory Trust is that a sponsor goes out and buys institutional quality real estate, and they sell fractional ownership interests for as little as $100,000 in that institutional quality property. This has a lot of advantages for investors, and the primary one is illustrated here in this schematic. You could sell one property, let's just say it's a single family rental property, for $1 million that you bought, but you're just not generating the rate of return that you thought. You can invest in a diversified pool of DSTs and almost build your own customized DST portfolio. you can pick and choose those investments based on their region, quality of the sponsor, and the property type. So you could dial that in very, very specifically. These portfolios are going to be passive ownership, right? So again, Max brought up that point earlier. Hey, you are tired of the headaches of managing a property and dealing with the toilets and things that are breaking. This could be a very viable strategy. It's very useful in estate planning, right? So if you own a portfolio of DSTs and you pass, your heirs get a step up in basis, and the beneficial ownership in those DSTs are divided amongst your heirs. You're going to get monthly cash flow distributions. And what is a real key attribute with DSTs is a lot of them come with financing in place. So if you're that investor who's selling an active property and you have financing that you have to replace, you have the ability to design a customized portfolio that also matches the debt coming out of your relinquished property. And that debt is non-recourse to investors that invest in a Delaware statutory trust. It's not something that you personally sign for. Now, while debt on any property can impact the overall risk of the venture, right? Because you have debt, it's not something that investors sign for, or I should say, have a personal guarantee against. So what are, again, the key drawbacks of DSTs? When we're out and we're talking to people, what do people come back to us and say that they don't like about DSTs? Since you're a passive investor in a DST, you don't have disposition control. That means that when you invest in a DST, you're trusting that sponsor, the entity that has purchased the property and packaged it and sold it to investors. You're trusting that sponsor to understand the real estate market that they're in, and you're trusting them to drive economic value. You're trusting them to drive rents that are going to ultimately drive the end value, and then you're going to leave it up to them to determine when they're going to sell that property. You may have a longer hold period. DSTs are typically 7 to 10 years, right? If your goal is liquidity, a DST would not be an option for you. But for a lot of investors that have built substantial wealth in real estate and are looking to plan, they don't want to be active managers, it is a fantastic solution, and a solution that they should explore and see if it fits within their broader wealth plan.
Michael, you said 7 to 10 years. So at the end of the hold period, then what happens?
Yeah, so typically the sponsor is going to be looking to sell that property. When we track the average life of DSTs that have gone full cycle, they've been anywhere from 6 to 8 years. Again, I think we've been the beneficiary of a really robust market, pushing those hold times down over the last few years. But essentially the DST life is fixed. So sponsors are really incentivized to be looking at full cycle opportunities, within that 8 to 10 years, if not sooner. And when it does go full cycle, Max, and the sponsor sells that investment, what happens is the proceeds, the investor would get a letter, we're selling this DST, we sold it, you've seen X amount gain. Now those proceeds, you have the ability to direct those proceeds to your qualified intermediary. And then you continue again along your 1031 exchange journey. So let's say, for example, you invested in a portfolio of DSTs, life circumstances changed, and you want to become an active manager again. Well, now you have that choice. The same decision tree that we had initially, you would have again.
Got it.
And we also put a lot of thought into portfolios. If someone has actively managed real estate before, but they want to take a pause in that, we do consider that as we design allocations. So it's highly unlikely if you have 4 DSTs, they're all going to mature at the same time. So we like to think about that so we don't limit what that journey looks like for investors. So I talked about this earlier, and I want to stress it because I think we're seeing more and more of this, especially in today's environment around financing. And this is the thought of, all right, I'm selling a property and I have debt that I need to replace in that property, right? So what's useful about DSTs, Delaware Statutory Trust, is you can build a portfolio to get that mixture of debt very, very precise. And you can use a product with more debt or a higher loan to value and combine it with products that have a lower loan to value to design that perfectly blended portfolio for your needs. So what I decided to do here is just, again, give you an example of a property where you have a significant amount of debt that you need to be replaced. And if you look at the allocation in the investment summary, they need to make sure that their portfolio has at least a 40% loan to value. And you can see how we've invested in 4 different DSTs with different property types, with different loan to values, to make sure that our financing or the loan amount is equal or greater to 40%. And in this case, we had, just shy of 44% loan to value. So this is the planning that goes into portfolio construction that, again, the team at My Financial Coach and the professionals that are there can help you along that journey to design that optimal portfolio. When we talk about DSTs and the types of property, lots of different options, right? All of these are things that would be considered like kind. I just want to stress it. I know there's a lot of medical professionals listening to this presentation. There are office and medical DSTs, and you can go from a medical building, selling a medical building, into any one of these asset types, whether it's multifamily, industrial, self-storage, senior housing. You have the ability, again, to look at any of these asset types, again, making sure that the structure around that asset type qualifies. All of these should be considered like kind. And for the purpose of this, there's product available in these asset types that also qualify as securities, where sponsors will wrap a DST structure around. I think here's where we get a little bit complex. Now, if you remember that decision tree, I talked about the path, right? We talked about the path of, hey, I can go direct, and then I have these options that are securities. There's also ways to combine strategies. Now, to make sure that we keep things consistent, I want to use the example that Max brought up earlier, right? Someone sells a property for $5 million, right? And they really want to go direct. Let's just say it's a medical office building. They sold it for $5 million. They decided to invest in another medical office building for $4 million, right? And they have $1 million in proceeds that are left, right? So instead of a car wash investment for this example, let's just assume that it's another medical office building. There's no reason why we couldn't help that investor identify 2 Delaware statutory trusts to round out that investment to help them mitigate the tax liability on that remaining $1 million. Very, very important. And this is how DSTs can be used and really complement exchangers' review of their entire pool of replacement properties. Is how can strategies be combined to mitigate taxes but also mitigate the risk of potentially closing on a property. So let's think about an example where that may happen. Same example, you're selling a $5 million medical office building and you're looking for replacement property. Well, there's no reason that you can't identify 2 medical office buildings that you think you're going to close on, right? And then identify a DST as a backup plan or as an insurance ID. These are the way that I think securities and direct properties go hand in hand. That's why we do a lot of education with real estate agents across the country to educate them on options outside of their respective skill set, right? So real estate agents might not know about the benefits of a DST. Securities professionals, which market DSTs, aren't going to understand the world of real estate brokers, right? So we do a lot of bridging. We do a lot of cross-pollinating to make sure that we help investors understand it's really not a one or the other, although they're 2 distinct paths. How do we bridge solutions to get optimal outcomes? Also, DSTs, 1031 exchange, combined with other strategies. Now, I thought it important to highlight this strategy because in many cases, we're going to come across a sale of a business. This could be a practice. This could be all sorts of things. 1031 exchange, and this specifically a DST, can be used together with other strategies. So this is an example of a farmer. This is an actual example where they sold a farm and they had other eligible gains that qualified for what is called a qualified opportunity zone. So in this case, we took the portion of the sale that was eligible for 1031 exchange and combined it with the portion of the sale that was given to us by the tax advisor as an eligible gain for a qualified opportunity zone fund. And we designed a portfolio that helped them to mitigate, defer, and design a plan that helps with future wealth building. So this is just one example, again, wanting to make sure people understand that this is out there. I will also preface that qualified opportunity zones without any sort of extension will sunset in 2026. There is some talk about them being extended to 2028, but there's a lot of benefits because the gain portion of the sale is invested in a qualified opportunity zone. And while you still owe tax on that, if you hold the gain portion in that investment for 10 years, you pay no tax on the back end. So another strategy that we bring to the forefront through My Financial Coach. So always thinking about how do we help people in the business sale situation look at the entirety of their options, combining 1031 exchange. I mentioned this before. I don't think I'm going to spend too much time on this slide, but again, we have the capabilities to work with a variety of structures. So again, with enough time in place, if you have an LLC or other sort of entity and you want to plan for the exchange, there's a lot we can do. But some of these strategies like a drop-in swap, I would encourage you to Google drop-in swap, read about it. It gives you the ability, if you want to separate from an LLC and do your own thing, or you're invested in a property together with other investors and you don't want to continue in the path of the LLC, this is something to explore that allows you to, again, give you a little more discretion in terms of the next leg of your 1031 exchange journey. For one of my last examples, I really want to talk about a strategy that has gotten just an absolute ton of interest. And this is also a strategy that I think is really filling a void in the current environment. And this is also a strategy where you can really leverage other tools that you have access to through groups that have partnerships in place with my financial coach, like Wellington Wealth Strategies, that help you get more diversification, give you a little more optionality in a 1031 exchange. The strategy I'm going to talk about is what's referred to as a zero cash flow DST. And typically, when we advise on these exchanges, it's very in depth. We're incorporating tax advisors and we're designing a hypothetical situation to walk them through their specific exchange math. For the purpose of this webinar, I'm just going to refer to a typical $10 million 1031 exchange. So we see exchanges of that size all the time. And that might incorporate the sale of a commercial real estate building, medical office building. All of those things could easily get you to that sort of example point. But in this strategy, what's going to happen is you are going to facilitate a 1031 exchange with the $10 million in proceeds with the zero cash flow DST sponsor. They're going to give you the option, and I noted 30 days here, but they're going to give you the option in 30, 60, or 90 days to refinance out up to 85% of the proceed value. So you're leaving in 15% of your equity in the DST, and they're going to let you pull out, in this example, 8.5 million in non-recourse debt. That 8.5 million can be allocated into a diversified pool of investments to help that client further diversify, or it can go into other strategies that are non-correlated to real estate. We are seeing a lot of interest in this strategy because what we see is happening is clients that have a lot of leverage are unable to get financing. And this, because of the high loan to value, is an exceptional solution. So we've seen the following application with this strategy. We have seen investors that don't know what they want to buy in the next leg of their exchange, investors that want to go direct, use this as a way to extend their timeline. Once they refinance the proceeds out, they're out of that 1031 clock and they can wait for the market to come to them. Right? Again, not knowing what they want to do, this is a viable solution. We see investors in sale leaseback situations where maybe you have a business owner and they're looking for growth capital. Sell the building, lease it back, and then when they sell the business, sell the building that's in the business, it's eligible for 1031 exchange. They 1031 exchange into this, and they use the refinance proceeds as growth capital. And then we see investors who have a high concentration of their wealth tied into real estate use this as a simple tool to generate liquidity and get diversified into alternative strategies. And the power of that, I think, is highlighted below with just some present value, future value calculations in this example, where on the left, you have 8.5 million invested in, let's just say, direct real estate earning 6%. That grows to roughly 27 million over 20 years. And then we see that same 8.5 million invested in strategies that might offer a higher rate of return, might have a different risk profile, but can offer a higher rate of return. The difference in future value between these two strategies over time is staggering. And that's what solutions like this, again, offered in partnership through my financial coach, can really change lives, can enhance wealth planning and wealth preservation. And this is always something that in an insurance ID, again, depending on the size of your exchange, could be a topic of conversation. So again, just to conclude, just making sure that everything that we're talking about today, we wanted to give you a really high level intro into, and are happy to get granular on your specific exchange. But let's just make sure we understand kind of the primary takeaways from this webinar. You always want to set up your exchange with a qualified intermediary. If you don't do that, you're likely going to put yourself in a situation where you disallow your exchange by taking constructive receipt of the funds. Not investing the full proceeds from the sale of your relinquished property. Max brought that up earlier. There's a lot of strategies where we can work together to make sure that we help you work on your liquidity and invest substantially all the proceeds from the sale of your relinquished property. Again, there's situations where liquidity, maybe the client doesn't want to, or the 1031 exchange, they don't have enough capital gains tax to make a 1031 justified. Those are all things we would talk about. You don't identify your replacement property on time, right? So just by not being active and knowing how fast 45 days can go by, you can run the risk of not having an optimal outcome in your 1031 exchange, right? So again, waiting to look for that replacement property, having difficulty closing could disqualify your 1031 exchange. Not using a reputable qualified intermediary, right? Things have happened, especially during the financial crisis, where people lost their funds in a 1031 exchange. So you want to make sure when you talk to a qualified intermediary, you make sure your exchange funds are safe. And lastly, in our environment through My Financial Coach, we don't push product. It is very important that we are product agnostic, solution agnostic. We leverage technology and we encourage collaboration together with you and your trusted advisors to make sure everyone's on the same page and you get an optimal outcome in your 1031 exchange. And that's all I have.
All right, thank you, Michael, Max, for presenting. We do have a number of questions that have popped up in the chat. I know that we are at the top of the hour, so we will go ahead and answer those. But if there are any additional questions from this, please go ahead and send us an email at customerservice@myfinancialcoach.com. Additionally, if there are any additional questions or desires to move into some of these strategies or ideas that we've explored today, please also reach out to My Financial Coach at customerservice@myfinancialcoach.com, and we'd be glad to see if this is a good fit for you. So first question is around the 1031 exchange. Let's say that you have identified multiple other investments that you want to put the 1031 into, but one of them or all of them fall through within that 45-day window. Are you able to have recourse, or is there perhaps any way to reset it, or are you potentially out of luck, or how does that work?
Yeah, Empo, great question. Within the 45-day window, right, they can always submit new properties to the qualified intermediary. It's after that 45 days, right, whatever the list is that the qualified intermediary has at the end of the 45th day, those are the properties that you'd have to close on. So, again, if something sells out from underneath that investor, they need to make sure that they identify another property with the qualified intermediary before the end of the 45th day.
Michael, would it make sense in that regard of always submitting a guaranteed close Delaware statutory as part of the identification?
That's one of the most common reasons why people use Delaware statutory trust is you have that certainty of close. And also, to the point of the insurance ID, Max, is, if they're going direct, right, and they're trying to close on a primary target, we always advise to utilize a Delaware statutory trust as an insurance ID, where if everything falls through, you have a decent chance of that Delaware statutory trust being available so that you ultimately have something to invest in.
All right. So one additional question that came through was regarding investments outside of the US. So let's say someone were to sell it in Costa Rica, Panama. Would it be possible to buy real estate in the United States as long as the investor were in the United States, or how would that work for 1031 exchanges?
So we're really talking here, Empo, about domestic properties
Okay.
being bought and sold. That's really what we're looking at. So selling a property in Florida, investing in something in Indiana.
Okay. So this question goes to maybe even Max. So let's say that you certainly like real estate exposure, but now real estate has become a larger portion of your overall investments. Is there any way where after you do a 1031 exchange that you are able to diversify, or are you always locked into real estate?
That's a good question, and probably a hybrid question with Michael as well. So on the, I would say using that zero coupon at the end is there's always ways to kind of refinance money out. So being involved in invested in the real estate, but being able to take those dollars and now do something else with them, right? And diversify your portfolio away from real estate, especially when real estate at current prices is, your IRRs may be anywhere between 4 to 7%, but the market long term is at 7, 8, 9, depending on where your asset allocation is. So there are ways to be able to take money out of real estate properties without having to pay the tax on it.
And I would just add to that, I think that's what this slide is meant to speak to, is that you can refinance the proceeds in your 1031 exchange, whether that's going direct, or in this situation with where it's a DST, there may be refinancing options available where, again, you can take the refinancing proceeds, to Max's point, and invest in investments that generate a higher rate of return, could be non-correlated to real estate, or again, help you meet your own specific risk return objectives. I mean, maybe you just want this to go into something that is hedged. All sorts of opportunity with the refinance proceeds that you can look at.
All right. Well, we want to thank everyone for joining us today for this very informative conversation on 1031 exchanges. And we appreciate everyone for joining us virtually as well in the future. If you do have any questions, once again, please reach out to us at customerservice@myfinancialcoach.com, or you can find us at www.myfinancialcoach.com. We look forward to presenting to you all soon.